corporate bond market in India is undergoing a transformation, reshaping the debt investment scenario. Now, many investors might view corporate bonds as the backstage crew of the financial world, working hard behind the scenes, mostly out of the spotlight. Yet, just the way backstage technicians are important for a successful show, corporate bonds are essential for the capital markets to function smoothly. The way corporate bonds are issued, rated, and traded in India today is evolving with far reaching implications. Hello, everyone. You are listening to Industry Wired Conversations, your front row seat to founder journeys, leadership insights, and the real stories behind how industries run. And I'm your host, Priya Diyalani. Now, the capital market of an economy is considered to be well developed only when a parallel development is ensured both in the equity and the debt segment. There is no doubt that the equity market in India is quite well developed and plays a crucial role in the growth of Indian economy. But unlike government bonds, the corporate debt segment in India is still in the nascent stage and requires a lot of initiatives to bring it to the global standard. Therefore, it has become very important to have a well run and liquid corporate bond market that can play a critical role in supporting economic development in India, both at the macro and microeconomic levels. Let's welcome Nishchay Nath, founder and CEO of Bondscanner, to discuss why strengthening India's corporate bond market is an important pillar for the Vikasit Bharat of 2047. Hi, Nishchay, a very warm welcome to our podcast today.
Hi, Priya.
Great. So, Nishchay, I guess we are going to discuss and know more about corporate bonds because I think our audience and even myself, we have a very basic and a fundamental knowledge of corporate bonds, but we definitely don't know the deeper significance or importance they hold and how they would contribute towards the ambitious Viksit Bharat goals of India. But before that, let's set the foundation and tell our listeners more about Bond Scanner, its specialization. Alongside that, a little bit more about you and what exactly is your role at the company today.
Okay. I'm kind of happy to kind of talk about Bond Scanner. It's one of our this is a product that we've been working on for the last year or so, and it's starting to take off against the backdrop of a very high scale, high growing retail market. Bond Scanner is a SEBI registered online bond platform provider. We enable retail investors to invest in corporate and government bonds, very similar to how you invest in a stock or a mutual fund through a broker. We are also a broker for retail investors to invest in bonds. Our specialization is more on the retail front and specific to the fixed income or the bond markets. And this is an area of interest for the regulators, for the government. And we identified this as a gap a couple of years ago and started working in this direction. Coming to why people invest in bonds and what is the use case for bonds, similar to how equity allows you to partake in the ownership of a company. And when you own a piece of the company, as the company grows, your wealth also grows according to that. Companies also use a lot of debt in the form of taking a loan from the banks, or they also issue bonds to raise money, raise capital from public markets. Or even in early stages, a lot of companies raise capital from their investors. This is bonds is an instrument which allows an individual to lend money to a company, and the individual, because of the nature of debt and the nature of loans, right, or the nature of bonds, just like how you pay an EMI on a car or a home, similarly, you get something like an EMI in the form of interest and principal payouts when you invest in a bond of a company. What this compares with is when you look at, say, FDs as a product, right? What banks do is whenever you make an FD with the bank is then in the business of lending this money actively to a lot of players, be it banks, be it companies, individuals, and so on and so forth. But you don't have a choice when it comes to which player you want to lend to. But the moment you start making a choice to decide as to who do you want to lend to is where you can choose the risk, you can choose the return, and you can create a portfolio as per your profile. For example, if you are comfortable with a sovereign grade security and want to earn, let's say, a 7%, then there is a range of government securities which are available. If you are interested in taking a little bit of risk, exploring corporate bonds, you can look at a AAA or a AA rated bond for as good as, let's say, an 8.5 to 9%. You would go towards more of the high yielding segments, wherein you go into, let's say, an A rated bond. You start seeing yields which are in the 10 to 11 to 12% range as well. So bonds kind of allow you to choose what type of risk you want to take, and you definitely have to kind of develop an understanding of what these risks are. But it allows you to kind of lend money effectively. In a nutshell, allows you to lend money to a company or the government, and you get a fixed return out of it. We guys have grown almost 200x in the last 7 months. We got our licenses last year. We built out the platforms, and the scale at which we've been growing has been quite rapid. We have more than 100,000 users on the platform, and we plan to be almost at about a million users by the end of the year. My personal background is I come from the private equity space. I have seen the debt markets evolve over the last decade or so, and I figured that this is an opportunity where I wanted to make this my life's work in order to kind of, if I could create the corporate debt markets, the corporate bond markets, and make it much more accessible to retail investors. That is the vision with which we are operating. We see that as India is heading towards, is kind of channeling itself towards becoming a $30 trillion economy by 2047, that is only and only going to be possible once the country embraces debt as a product and the government realizes that, and we are playing a role as bond scanner to create and proliferate the debt markets in the country. So that's a bit about us and our journey.
Great. Thank you for that overview, Nishchay, and also helping us understand with a brief overview of the corporate bonds and the entire market. And we're really glad to understand about Bond Scanner and also your leadership together. It's creating a meaningful impact in the overall industry. Moving ahead, I think India's corporate bond market experienced a notable revival in 2024 following a period of subdued activity, including the infrastructure, leasing, and financial services crisis in 2018, the pandemic in 2020, the rising interest rates in 2022, and the amendments to debt fund taxation in 2023. According to AMFI data for February 2025, corporate bond funds witness net inflows of more than 1,000 crores rupees. So, why, according to you think that the development of a strong corporate bond market is very critical to India's vision of becoming a Vikasit Bharat?
Okay. I think there have been a lot of regulatory changes with regards to how fund management happens. But when we look at specifically the corporate bond market, right? In the corporate bond market, SEBI came out with an OBPP licensing framework almost about 3 years back. Then they've also led to the formation of an OBPP association, which is an industry-wide organization in order to kind of create different form of regulations in order to kind of make the corporate bond markets even more better. And then SEBI also made amendments to the advertising codes so that retail-oriented platforms can kind of make the offerings reach the masses. All of this has happened because if you look at, because the government eventually has actually realized that debt markets need to be created, debt markets are needed, and a chunk of the retail capital is needed in the debt ecosystem. On one side, the story of equities, if we see, there has been a lot of influx in the last 10 years of retail investors coming into the fold of having demat accounts and investing in the markets. What this has led to is a lot of retail investors have added capital and have created this one cushion that whenever, say, any form of recessionary pressures, let's say the pandemic came or there were certain liquidity crises which had happened, more recently there has been volatility in the market because of a lot of macroeconomic factors, wars, blockages, and so on and so forth, which are happening. But India's equity capital markets, or capital markets more from an equity spin, have been very stable. Have been, I mean, people have been complaining about flat returns, but what this also means on the other side is that our economy has not jumped around. Let's say how, say, South Korea has been suffering, right? Recently, India has built this very beautiful retail layer which has protected India as an economy from a lot of market forces. The same kind of a layer, when it comes into the corporate bond markets, one allows us to become a much more robust economy. So one of the contexts which I'm setting is retail creates a very robust capital market ecosystem for the country. And this is for every country out there. Second, if we look at some of the more developed economies, right? Let's say something like the US. In the US, the debt markets are much larger than the equity markets, and the retail participation in debt markets is also larger than the equity markets. When we look at India, we are sitting at about 17 to 18% of GDP as our debt market size. And even NSE has estimated that we need to get to 35% in order to satisfy our internal debt requirements that we have, right? We as a country, we see close to like a 250 to $270 billion like a debt requirement, which is not fulfilled every year. And this is a huge blocker to growth of companies. So with the vision of Viksit Bharat, as well as creating a robust economy, we need to bring in capital into the debt ecosystem, be it through retail, be it through foreign investors. And these are some of the larger, more macroeconomic levers which are being created by the regulators as we speak. So, apart from just the corporate bond markets in India, the regulators are also, I mean, very recently they have opened up or they're easing out the regulations for foreign investors also to be able to park capital in the country. The whole purpose of this is that the government realizes that debt is the solution for us to meaningfully scale into a developed economy by 2047. So that's our view on how it would pan out for us as a country.
Great. I think that really puts the importance of the corporate bond market into perspective because, I think equity markets often dominate public attention, but a well-developed corporate bond market plays an equally critical role in building a resilient and mature financial ecosystem because it not only provides businesses with access to long-term or cost-effective capital, but also reduces excessive dependence on bank financing and creating a more diversified and stable funding environment. Now, with that being said, while we discuss the importance, I also want to discuss the other side of the coin, which is the challenges that can probably limit the growth of India's corporate bond market. I mean, the market has evolved over the years. Its depth and participation, I think, still remain relatively limited when compared to the other developed economies. So, what are certain structural challenges you think India is facing currently in terms of boosting their corporate bond market?
Okay, I think this is a very important question that you've brought up in the podcast, and I want to talk about it in detail. Now, there are these problems of marketing the corporate bond market, right? And equities on, or I would say other products like say equities and crypto, they are much more exciting and they're easier to market. Corporate bonds and bonds in general is a very boring market of sorts. So it's very difficult to market it. So marketing problems aside, there are severe structural problems, or I would say not severe, but real structural problems, which once solved or while they're being solved, they will allow us to kind of multiply the entire corporate bond market. The first issue is that when we look at, let's say, what type of ratings are available, right? So the spectrum goes through G6, AAA, AAA, and it goes triple B, double B, and goes into junk after that. We see that most of the larger issuances are, or the more publicly accessible issuances are AAA or AA by nature. And the larger blue chip companies are able to kind of raise capital through the corporate bond markets with a great amount of ease. But getting to, let's say, a AAA or a AA rating means that companies need decades of history, they need decades of financial prudence, and accordingly the price also gets risked, like the risk also gets priced into the bond. When we look at growth, we also need some of the more younger players who have, say, taken birth in the last decade or two in order to kind of come into the market and be able to raise meaningful capital, because after a certain point in time, even bank financing can become expensive, and which is where and bank financing tends to be more shorter term by nature. So companies need to raise longer term capital at better rates than what they are already doing, and they need to be able to access the bond markets. And even though they would be an A rated bond, being able to issue a bond is something which the regulators are currently working to make it much more easier, ranging from how the ratings happen to how the listing process is to who all can subscribe and how can it be sold. These are certain pieces that the regulators are working, and is the first issue is issuing the bond, and that's a structural problem to be solved for. The second problem when it comes to creating of a market is not just being able to buy bonds, but also being able to sell bonds and liquidity. Like, for example, if I were to hold equity of a company, let's say Tata Motors, right? And if I need any form of liquidity, I can simply sell it through my demat. But in the bond market, this is difficult to do, especially if you are a retail consumer. Getting someone to buy a small lot could be challenging, and you might have to give a much more discount, right, to it. So there is a absence of liquidity. I would not say 100% absent, but liquidity as it should be is doesn't exist. There is a significant amount of efforts which are being made by a lot of different bond players together, debt players together, to kind of create this liquidity in the market, so that once this liquidity is created, we would be able to kind of put ourselves out there more and market ourselves out there more. And liquidity is a problem which is a genuine concern for the retail investors, because the comfort of an exit is what allows someone to take a much bigger position or a much bigger allocation in the product itself. We see that this liquidity creation, there are certain pieces which the regulator will help in solving, but it's actually players like us and other brokers who will have to kind of step up in order to kind of create this liquidity. Third, and this is the change which is the initial regulation which had come out, is that most issuances on the higher yielding front are private by nature because they need to be sold faster. Let's say if there is a bond which is triple B rated, it will give you, let's say, a 12.5 to 13% yield on that paper. If they come into the retail markets, people will not subscribe to them because they're relatively unknown, they're smaller, while their interest rates are kind of lucrative. So SEBI has kind of reduced, and initially, by the way, the ticket sizes used to be 10 lakh rupees, used to be the face value. That has been reduced to 10,000 rupees almost 3 years back. And but it continues to be sold to institutions in order to kind of subscribe them fully and then open it up to retail markets through the secondary routes. I think here we need more public participation, and this is going to be a factor of how much education is created in the bond markets, especially in the retail audiences. And I mean, I love being on this podcast because it's a method for me to kind of spread this awareness of how good the bond markets are and how to kind of navigate it as well, because it could be dominating of sorts. And yeah, I think I've talked about this problem multiple times. Lastly, building awareness of bonds at the grassroots level is something that we would need to kind of create. Our FM had done some significant announcements in this year's budgets with regards to the corporate bond markets, and they are starting to kind of play out as we speak. There is a tagline, there are a bunch of stuff which the regulators as well as the government are taking, and we are also kind of acting as the bastions of this mission of Viksit Bharat through the corporate bond markets. So I think the fourth structural problem for us to solve is literacy with regards to bonds as a product. And I think solving these four big problems will allow us to create a much more vibrant bond market. We are very lucky to have a regulator such as SEBI, who is extremely proactive directly and through the exchanges. We keep working with them extremely on a hands-on basis, and we will start seeing a lot of market making oriented initiatives being taken and policies being changed, which will lead to the markets being created in the longer term.
That's a very insightful overview, I would say, Nishchay, and thank you for sharing those structural challenges. And I think it really highlights that, India is definitely making a significant progress in its financial markets, but the corporate bond market still has to overcome a lot of challenges, and it requires deep structural reforms to unlock its full potential. And of course, addressing these challenges will require coordinated efforts from regulators or market participants, issuers, and investors. And that brings me to my next question. I think government initiatives and private sector participation, or even public private partnership, the PPPs, they play a significant role. And, they are innovating financing mechanisms, are becoming equally important in bridging the funding gap. But I think financial instruments that align capital with sustainability objectives are increasingly shaping how large scale projects are planned and executed. What role do instruments such as green bonds or sustainability linked bonds play in financing India's future?
Okay. So green bonds, all the sustainability linked bonds are generally, I mean, infrastructure related bonds. And the government comes up with these initiatives, or they kind of grant the ability for certain PPPs to be able to issue or raise money through these bonds with a lot of tax advantages as well as currency advantages in case if there are some foreign investors which are coming in. These type of instruments allow India to kind of see, rather than just relying on taxpayer money or on larger PSUs and institutions who have capital with them and them deploying that capital, such instruments allows India to open up its infrastructure projects to the world. And we need to focus on improving our transportation. We need to improve the way we consume our energy. We still have severe problems on the front of good quality water, good quality transportation, and so on and so forth. So I think these problems, once they are solved, it allows us to become a much more vibrant or a very good investment destination. It allows a lot of global citizens to move to India, a lot of global capital to move and invest into India. And even India's economy becomes much more faster. Some of the models which have worked out very well in this segment are, let's say, a lot of Middle Eastern, a lot of countries in the MENA region have raised capital through this route, through global markets, even though they have their own capital. But that has allowed a lot of influx or a lot of globalization to happen, a lot of capital to move in, and thereby leading to the development of the local economies altogether. So, in order to open one of the taps of financing for these projects, bonds are a great route. And especially once you start constructing them as a green bond or a sustainability linked bond, it links a lot of the financial incentives to the bond itself and makes it extremely attractive. We love to call them as a very natural financing tool for highways, ports, and so on and so forth to be funded. And especially there is also this angle of them being a little bit long term by nature. People can kind of lock in their returns, sleep comfortably at night because a lot of them are also sovereign, guaranteed by nature. I think we will see large global banks are already moving into India to kind of fund these projects and to open India's bond markets to the world. So these are very exciting instruments when it comes to global markets.
Definitely, Nishchay. And as we conclude today's conversation, it's evident that India's journey toward becoming a Viksit Bharat will be shaped not only by just bold aspirations, but also by the strength of its financial and institutional foundations. From accelerating clean energy adoption and building resilient infrastructure to deepening the corporate bond market and unlocking long term capital, every piece of the ecosystem has a critical role to play. The opportunities before India are immense, but realizing them will require sustained policy support, market innovation, and close collaboration between the public and private sectors. Thank you, Nishchay, for sharing your valuable insights and helping us better understand the forces shaping India's economic and financial future. It was a pleasure having you with us, and we look forward to seeing how these transformations unfold in the years ahead.
Thank you, Priya, for having me here.
Thank you so much. So, this is for our listeners. I hope you enjoyed today's discussion around why strengthening the corporate bond market of India is crucial for India to achieve its long term ambitious goal and definitely call out as a Viksit Bharat. Stay tuned for upcoming episodes, and you can view all our previous episodes on Spotify, YouTube, and SoundCloud. Thank you so much.